Takes us to our talk of the tape. The rally back in stocks over the past couple of weeks, whether there's enough staying power now to sustain that move. Let's ask Tony Pasquariello. He is Goldman's head of hedge fund client coverage. Joins me back here at Post 9. It's good to see you again.
Thanks, Scott.
So have the bulls wrestled back the momentum that seemingly was lost just a couple weeks ago?
S&P up 5 days in a row, subject to the next hour. We're just 1% or 2% from all-time highs. I would say the momentum is back in favor of the bulls. It's been kind of an interesting month, I think, as you said, a tale of two different months.
Sure.
Those first 3 weeks, I think we felt the pinch of higher interest rates along the entire curve. I also think the market started to wring its hands around the trajectory of Chinese GDP growth. As you flash forward to today, I think we're breathing a little bit easier on both of those narratives. I'm not sure they're fully gone from the equation, but I do think in the end, the story of late August has been the story all year, which is the market strength has been driven by the ongoing durability of the U.S. economy. Big card comes over tomorrow. And, of course, the supremacy of U.S. tech. And so I still think those are the two big variables in the equation that the bulls have on their side.
Well, let's take a few of those things. So consumer. No concerns that the consumer is about to crack in any meaningful way?
I think there's two headwinds coming at us. One is the resumption of student debt, and the other is kind of the ongoing drawdown of excess savings, particularly down the income strata. That said, let's think about this. Over the past couple of weeks, Walmart, Home Depot, Target, Visa, they've all basically told us the consumer's fine from a macro perspective. Now, there's other data points against that. We saw one this morning, Dollar General. Then you look at the government data, you look at personal spending this morning, you look at retail sales earlier in the month. I think the big ball for the consumer is if we're right and the unemployment number tomorrow is 3.5% and we continue to generate kind of above trend wage gains, I think one can only go so far with worrying about the U.S. consumer.
Yeah. How about yields? Right, that's the big equation, right? That still matters more than anything in terms of what we're going to do in September. Is that right?
I think that's right. It's been a really interesting sequence because if you think about May, June, July, when the equity market really found that upside convexity, in a way it was kind of impervious to the move higher in yields. Again, that cat and mouse game changed in the month of August, and you could just kind of feel it on the front of the month when U.S. rates moved higher along the curve and introduced an element of turbulence or impingement on the equity market. You get slightly cooler data, the bond market settles in, and the stock market moves higher. It's very reflexive in that regard. Again, my guess is rates will be here or higher for a while longer. I think the fundamental driver of higher rates has been good growth data, point to point. And again, I think that's on net positive for the equity market, even if on a given day or a given week, again, it introduces an element of turbulence.
But softening data over the period of the next month is a good thing for stocks. I don't want to say it's not necessarily bad news, but a little bit softer economic data is exactly what the Fed's hoping for and perhaps what investors think they need to believe in this Fed being done narrative a little bit further.
So I think we should I'll take the labor market as an example. I don't think we're rooting for uniformly bad nor good news. I think if we walk out of the office tomorrow and then the news of the week is basically job openings down, quit rate down, wages well behaved without job loss. Say 149,000 jobs are printed tomorrow. That's our forecast. 3.5% unemployment rate. I think the composite, I think that's a very tidy story for the Fed. Mm-hmm. I think that's a good story for the bulls.
Are you a believer in the earnings story? Speaking of stories, I mean, the estimates at this point are like this third quarter is the turnaround quarter. You incrementally go positive, and then fourth quarter follows through further, and then you make a real good turn into 24. Does that make sense?
Our call as a house is 224 for this year, which is plus %, not that interesting, and then 237 for next year, plus 5%. We agree the sequence of basically the year is Q2 marked the low in earnings, and in the end, earnings came out better than we expected. So given, I'm sure we'll talk about this, given what a large share of the equation mega cap tech represents, given what we've seen from those top 7 companies, I think if I'm going to bet, I'm going to take the over on 224 and 237.
You were as wowed as anybody on NVIDIA's results, weren't you?
Well, I think, the AI theme is interesting, right? Because if we were sitting here 3 or 4 months ago, it felt like a new world had been revealed. Okay, the market picked that up. It became prosecuted very clearly in NVIDIA, in Microsoft, in Google. So today it's a more well-known variable. But again, I think if this is the early innings of a secular shift, that is our view. I think that's the view of most people. As the great Stan Druckenmiller would say, these things don't go on for just 10 months. NVIDIA bottomed in October. ChatGPT was announced in November. So again, big ball, long run. I do think it's early innings. And again, the companies at the top of the index have the most leverage to that theme.